Hello, and welcome to the BioSyent Q3 2017 results presentation. My name is Rene Gorham. I'm the Chairman, President, and CEO. Just want to bring your attention to our disclaimer statement, and I'll move on from there. So let's take a look at sales, EBITDA, and net income for the quarter. Sales reached $5.4 million, which was 13% ahead of year ago. EBITDA was a little over $1.7 million, which was 5% ahead of year ago, and net income after tax just short of $1.3 million at 4% of year ago. If we look at the 9-month YTD number, sales were just short of $15 million, 15% ahead of year ago. Our EBITDA was just under $5 million at 15% ahead of year ago, and our net income after tax $3.75 million plus 17% versus the 9 months ended September 30th of 2016. If we look at the makeup of pharma sales, you'll see this chart representing the last 5 years, so 20 quarters of pharma. You can see the business progressing with some peaks and valleys. Of note, our international Pharmax business now has recorded sales in 11 consecutive quarters. We do see some variations quarter to quarter. You can see that represented in the blue shaded tips. So we do see some variations. It's now a regular feature of our business. We have some ongoing markets internationally, and we have some additional business coming in that regard. In Canada, the pharma business was up 16% versus year ago. The international up 5% versus the year ago quarter. In no way indicates a deceleration of the international business. We've got visibility now into the fourth quarter orders. We've already started shipping, obviously. Assuming that we get the final kind of country permissions that we expect to top up what we've already got in. These are not regulatory approvals, these are more import approvals that we expect the quarter to perform quite well for the international pharma business and overall to be kind of in line with our budget and plan. So let's take a look at a couple of the highlights for the third quarter. The Pharmax business in Canada was up 12% in units. You'll recall that we had less growth early in the year on Pharmax due to trade inventories reducing. That's a weak supply that they had in their warehouses to support pharmacy demand. Pharmax powder business up 20%, Repagyne and Cathogel up 7% versus the same quarter a year ago. On the next slide, I'll show you how overall both Repagyne and Cathogel are performing better on a YTD basis. So this is really quarter to quarter, month to month. You can have a swing in inventory. I prefer to look at this business, these products, more on a longer term basis, but obviously we are reporting third quarter results right now. So on Pharmax, international was $600,000 measured in Canadian dollars in sales for the quarter. This indicated up 5% versus the year ago Q3 2016. And our legacy business, which we don't talk about a lot, but the legacy business has continued to contribute nicely to the business. It doesn't get a lot of time and attention and focus in the organization, as it shouldn't. It's not something we invest in for growth, but it's been a steady contributor. So if we look at the first 9 months, this is going to bring it back to what I commented on Pharmax. I'll just start with the top line. So over 9 months, our pharma business up 15% versus 2016, and that's made up of 12% performance in the Canadian pharma business and 53% on the international Pharmax business. So I mentioned earlier that there was a contraction of trade inventories in Q1. That obviously affects the kind of the YTD 3-quarter performance. But as noted on the previous slide, our units were up 12% in the third quarter. We are already, as I'm recording this, pretty close to mid-month in November, so we've got decent visibility. We've had very strong October and a good start to November. for the FeraMAX business. So I think the trend of what we saw in Q3 is continuing as we go forward. The FeraMAX powder business through 9 months is up 17%. And as I mentioned, RepaGyn and Cathogel, a much stronger growth measured over a longer period of time, 23% for RepaGyn and 18% for Cathogel. And the legacy business up 14% versus a year ago. I think of note there is that we've added one new export market this year. This is something that was initiated several years ago. A distributor had approached us about a new export market. It's something that they did the work and they invested in. They got the authorization this year and made the first commercial sales. Obviously, we recorded that in the third quarter. It's not a business that we know a lot about, and we don't have too much visibility on it, but it's been a nice addition to our performance in this quarter. I wanted to highlight our performance on the launch products. The products we've got in the roster right now that we consider in launch phase, the Aguettant System, prefilled syringe, and Cysview. So the prefilled syringe, Aguettant System, in dollars, we're up 2.5 times the YTD period in 2016. Just a reminder though, atropine was relaunched in Q1 of 16 and phenylephrine was only launched in fourth quarter last year. So it's off a pretty small base of business. The sales are in line with our expectations. This is a business that takes longer to build. We've got a lot of call points in a hospital to get adoption of these products. We're making good progress in both cases. We've got ongoing business for both compounds. Phenylephrine is in an earlier stage, but we've got sites that are now consistently consuming on a monthly basis. So essentially, although this product has been in Europe for some period of time, I consider it, the proof of concept in the market where it's actually getting used and consumed. Sites that are using are growing every quarter, and customers are happy with the product, and we're fine-tuning our pricing. So a good indication that we've got a decent growth runway for the Aguettant System over the next couple of years. A few comments about Cysview. No question this brand has performed below our expectation. We have seen clearly that it delivers on the promise of addressing an unmet medical need and assisting the healthcare professional in providing care to their patients. The challenges have really been around hospital administration and hospital budgets pushing back on adoption. We now have 2 hospitals that have adopted and are using Cysview in surgical procedures to better identify tumor under blue light. We've had a cost-effectiveness study that was published in the CUAJ in June. So all of the marketing steps that need to have been undertaken over the last year and a half to kind of move the market to adoption have been put in place. We've got a number of hospitals that have now done evaluations that is using the product in the operating room to resect bladders in non-muscle invasive bladder cancer, are not just impressed but pleased with the performance of the product. They typically are finding tumors in the bladder that they miss under white light, which is the standard of care. We've got evaluations scheduled in 4 additional hospital sites. We're really working the teaching hospitals at the moment, though there is a lot of interest in the community hospitals. So though the brand has delivered less on the top line and certainly bottom line contribution to the business than we expected, it doesn't mean that we don't have confidence in the product. It's just taking us some time to build momentum in site adoption, which then translates to units and therefore dollars. Just talk a little bit about the third quarter activities and after the third quarter. So in August, we appointed a new Vice President of Business Development. That was a vacancy that we had for some time. Obviously, our business development activities didn't stop during the vacancy. I would say have now accelerated. We've got a number of initiatives that are on the go. When they come to fruition, we'll be announcing. BioSyent was named to the Profit 500 ranking of Canada's fastest growing companies. This was our 5th consecutive year. It's what's of note there is that it's on every year it's on a higher base. So in the period that they measured here was ending 5 years ending 16. We grew at 538%. Our women's health product that we've got in at Health Canada's passed screening. It's an important hurdle to make sure that Health Canada's got all of the data in the dossier to go through their process to approve the product. It's obviously not going to happen this year. It'll be well into 2018 we expect for marketing approval. And during the quarter ended Q3, there were 26 new Canadian hospitals that ordered the Agaton pre-filled syringe system. So as we look to the fourth quarter and beyond for growth drivers, this slide hasn't changed a lot. I can say that in the fourth quarter, we've had a number of brands deliver record months in the month of October already. So we're feeling quite confident that we're on track for our year this year to meet our plans and expectations. We think that going forward into 2018, there's more growth in FeraMAX. Obviously, I've just finished my comments on Cysview. We think that there's revenue growth contribution to come from Cysview, from Cathogel, Repagyne and Agaton system. We've got new products coming. The women's health product that I spoke of, that's in the regulatory process. We're getting the dossier prepared with our partner for two, or dossiers I should say in plural, for two new cardiovascular disease products. So we see organic growth from existing products, existing markets. We see new products coming that should deliver a pretty decent runway of growth moving into the future. I mentioned that we're active in screening, diligencing, and negotiating on new products for in-licensing. I would say an additional feature of business development activity is to look at acquisition opportunities, primarily products. So these would be products that are in the market and revenue generating. We've had contact and or discussion with a number of larger pharmaceutical companies in Canada to see what assets might be available for divestiture or acquisition by BioSyent. We are as discriminating on that front as we are on any in-licensing deal. So that's really an ongoing process as well. There's nothing imminent, nothing that's going to be reported that I could say, but it's just now an ongoing active part of our business development activities, portfolio expansion. Quick look at our balance sheet. Not a lot has changed on the balance sheet. Our working capital is up. Our cash has grown 20% from December 31st of 16. We're now at $16.5 million as of September the 30th. As we've reported for quite a long time, we don't have any debt, short-term or long-term. We have debt facilities available from the Royal Bank, but at this stage of growing our business without, I think most of you will appreciate that we're generally a capital-light business model, and we'll be looking at acquisition opportunities to deploy that capital. They'll, as we move into the future, really more 2019, there'll be some additional requirement for working capital as we launch additional products on inventory, some additional people. But for the most part, the cash position that's growing on our balance sheet will help us when we're looking at acquisition opportunities. So speaking to our cash generation, you see here our ability to generate cash from the business has accelerated in the first 9 months of this year versus last year. This year's YTD cash generation of just under 2.8 million versus 1.7 million in the year ago period. So as we look at our return on equity, obviously the cash position of the company is a big part of that calculation. So for the 12 months ending September 30th, ROE was 27%. You can see clearly that on this graphic that's been a decline over the last couple of years. We went from a period of really not having much in the way of equity or assets in the business. Now a much stronger cash position on the balance sheet. That does weigh on our ROE, but we're not going to apologize for delivering 27% ROE over the last 12 months. I think I've already spoken to the fact we're constantly on the lookout for acquisition opportunities with respect to products, not so much company at this stage. We're just going to be as discriminating as we always are to make sure that we get the right fit financially, something that meets our hurdle rates. For the time being, that cash position will grow. You should know the management of your company is certainly looking for ways to productively deploy that capital. Our EPS for the quarter was 9 cents. If you add that to the 3 previous quarters for a rolling 12-month ending Q3, we've earned 34 cents fully diluted. That compares to 27 cents in the previous 12 months for a TTM EPS growth rate of 26%. Quick look at our shares outstanding. So we're at a little under 14.5 million shares outstanding, 150,000 share options issued and outstanding for a fully diluted of 14.64 million shares. We appreciate your continued interest and support for the business. We're as excited today as we have been all along in growing our business, the growth opportunities. I think you'll see that changes are more incremental in the way that they're measured, but it's steady onward progress. We see continued organic growth from the existing products. We see opportunities for our new products coming to market and in licensing additional products. So we feel quite comfortable and confident that we've got a long growth runway ahead, and that we'd be able to deliver superior results over that period of time. So we look forward to sharing our progress with you next quarter and through 2018 and beyond. Thank you.